Are you a home buyer sitting on the sidelines waiting to pull the trigger on purchasing a home, thinking that the market may crash? Or maybe you're one of the doom and gloomers out there looking at all the forbearance data, thinking that all of these people who took mortgage forbearance back in March will eventually turn into foreclosures because they're unable to pay their mortgages. My name is Jeb Smith. I'm a real estate broker here in Southern California. In today's video, we're going to discuss data that was put out by Black Knight a couple of weeks ago that talks about forbearances, talks about delinquencies, to give you some insight on what I, as a real estate agent with boots on the ground, expect the market to look like for the next couple of years. We're going to dive into these forbearance numbers. If you've been paying attention to the news at all, this past week, forbearances dropped below the 3 million mark for the first time since March. So forbearances have actively been going down since March. But what does that actually mean? How many of those people are current on their mortgage? How many of those people are in default? How many foreclosures should we actually expect? And if they do foreclose, if we have this foreclosure quote unquote wave coming, are you going to be able to pick up property really cheap, or is all of that property just going to get soaked up because of buyer demand? Well, that's what we're going to discuss today. So do me a favor, if you like content like this, hit that subscribe button. And if you like the video, give me a thumbs up, leave me a comment, question if you have them below, and I'll go back and address those for you. But let's take a look at this report that came out from Black Knight. I will link to it below in the description so that you can go over the full report. I'm only looking at a portion of it for today's video in order to keep this short, concise, and to the point. But I'll link to it if you want all of the information to dive in deeper. So here is the report we're going to take a look at now. These numbers are from August, right? Every month is, for September, this report's not going to come out for another week or so, at which point I will update the data. But so this is from August, but the numbers have been trending down. So you can use this as, kind of a leading indicator as to where we're going. So of the 6.1 million borrowers who were in COVID-related forbearance plans, 41% of those people had exited. Again, this is as of August. Since then, forbearance numbers have actually gone down, so these numbers will likely improve, with the vast majority of those, which would be 1.8 million, currently performing on their mortgages. So they're saying, these people took forbearance, the forbearance ended, they are now back to making their mortgage payments. Those people are performing on their mortgages. 6% have paid off their mortgages in full, either from refinancing or selling their property. So another 6%, in addition to that 41%, have either sold their property and or refinanced. 267,000, so another 4%, remain past due on their mortgage, but are in active loss mitigation status, meaning that they're working with their servicer. So, because they are past due on their mortgage, that's normal. Because they're in forbearance, they don't have to pay their mortgage, which means they're past due. So don't look at that number as some big indicator that all of these people are so many months past due. They're in forbearance, they're actively working with their lender to try to figure out a plan. And you have just 54,000 loans that are past due and not in some sort of active loss mitigation. And 70% of those were already delinquent in February before this ever began. So 54,000 are past due in active loss mitigation. 70% of those were already past due in February. So I can't do the math off the top of my head, but that's roughly what, 30,000 or so were already past due in February. Now, status of loans that have left COVID-19 related forbearance plans, 35% of that population are back to performing on their mortgage, with 8% having paid off their mortgage in full, either through refinancing or the sale of their home, both of which are the highest such rates among any investor category. So these are from different GSEs, FHA, VA, these are government sponsored entities here that we're talking about. FHA and VA loans have been the lower share of borrowers actually exiting forbearance plans. Typically, these are lower down payment loans, and these people are asking for extensions and either or staying in forbearance longer than those with conventional loans. Among FHA, 21% are performing, while 7% remain past due and in active loss mitigation. So they're trying to work out a plan. 4% of FHA loans have been paid in full. VA loans have seen a higher paid in full rate at 8%, while 19% of those forbearance loans are currently performing. Now, national payment to income ratio. So if we're going to go back and look at history for a moment here, and back in 2006. So at that time, interest rates were around 6.5%. Borrowers were spending nearly 34.34% of their income towards their mortgage each month. So a large percentage of their monthly take home went to pay off or pay towards their mortgage each month. Now let's go to 2020. Interest rates are at 2.86%. Last week we got an update that the average interest rate has dropped, is around 2.8% as a nation. So interest rates are very, very low. And we have news from the Fed that they will stay there through 2023. But look, you've got under 20% of those people actually spending less than 20% of their income towards their mortgage. So significantly less than 2006. People are spending less of their money towards their mortgage, and it's likely due to low interest rates. So, and keep in mind, this is people that are assuming a 20% down payment and a 30-year fixed rate loan. So as of September, it now takes 19.4% of the median household income to make the monthly payment on the average priced home, assuming a 20% down payment and a 30-year fixed rate loan. So that is a 0.4% improvement over August, and the strongest affordability in the housing market since October of 2016. Each of the 25 largest U.S. markets are seeing their strongest affordability since the first quarter of 2018, with 16 seeing the strongest affordability level since 2016 or prior. This goes over the affordability for different markets. I'm in LA, current payment to income ratio. So LA has the highest of this category, spending the most amount of money towards their mortgage based on what they take home, with Detroit being the lowest. So LA is the highest, and that's why you're seeing a lot of videos online on YouTube of different YouTubers, of different high profile people leaving the state of California because of affordability, taxes, Democratic majority in the state. There's a lot of things that are pushing people out of the state, but one of those is affordability. Home appreciation versus the 30-year fixed rate mortgage. We've talked about this in other videos, but as of the end of July, there were 1.5 million existing homes for sale. That's 20% lower from the year prior, and the lowest July month in number since the housing recovery began in 2012. So you can see here that interest rates are going down, home appreciation is going up, and on this side, you've got inventory essentially going down. So, where number of used homes for sale is the green number, annual change is going down. So inventory is going down, home prices are going up. We've talked about this in other videos, but my thought is, and my prediction is, any homes that come on the market as a result of foreclosure, from delinquencies, from mortgage forbearance, from any of that stuff, is likely going to get purchased rather quickly because of how high buyer demand is. Buyer demand isn't going anywhere because inventory is, so suppressed. Interest rates are going to stay low for the next couple of years. They can't raise interest rates, otherwise it would crush the economy. So you're going to see interest rates stay low. You're going to see inventory likely stay low, especially through the next couple of months. You're going to see less inventory the next 3 months than you've seen in a very, very long time, because this is the time of year when people don't want to sell their properties because of holidays, because of, what have you. They don't want people walking through their houses. And then you take COVID on top of it. People are worried about getting sick, and, the holidays, you're going to have less properties coming on the market, which means buyer demand is likely going to stall a little bit. You're going to see the drop in buyer demand just because there's not going to be houses to purchase. But as inventory picks up, you are going to see buyer demand pick up, and inventory levels are going to stay low for some time. My prediction, of course. Let's see here. So basically, in this chart here, it shows tappable equity of U.S. mortgage holders. So what it shows here is that people have more tappable equity in their home than they've ever had before. And I've talked about this in other videos as well, is that, just because people are say they're behind on their payments, or they're unemployed or what have you, that doesn't mean they can't sell their property. This is showing you right here that buyers, homeowners have equity in their property. They're in a position to sell their property. They're not in a position where they have to foreclose, where they have to short sell. This is not the market that we're in, guys. This is completely different than 2006. Nearly 45 million homeowners have tappable equity in their homes, the largest volume ever. The average homeowner now has 125,000 in tappable equity. That's an increase from last year. We're going to go down here. So negative equity volumes and rates. So even applying distressed valuations to properties 90 or more days past due, the national negative equity rate has risen only 40 basis points year to date, from 1.4% at the start of the year to 1.8% as of mid-2020. Fewer than 1 million mortgage holders currently owe more than their home is worth. So very few people in the grand scheme of things actually owe more on their home than it's worth. Only 9% of borrowers in forbearance have less than 10% equity in their homes, with just 1% underwater. GSE and portfolio loans in forbearance have even stronger equity positions, with 4 and 5% respectively having less than 10% equity in their homes. So the majority of people have equity in their homes. They would be in a position to sell if they needed to. They don't have to foreclose. They don't have to short sell, which is what a lot of people are expecting, buyers or homeowners to do, if they're behind on their payments. That's why I think you're going to continue to see the housing market do exactly what it's done this year. 2021 is going to look a lot like 2020, in my opinion. You're going to have low inventory, you're going to have low interest rates, and buyer demand is going to be essentially where it is now, maybe even higher if interest rates continue down. The one big factor in our market that's going to keep it from really thriving is the lack of inventory, where it's going to be a struggle because you have people that need to buy a property in order to sell their property. They don't want to be quote unquote homeless. And so those people are keeping homes off the market, right? And so until more homes start to come on the market, those people aren't going to want to put their homes on the market, so on and so forth. And what I'm seeing right now with boots on the ground is a lot of buyers are contingent. They're contingent on selling their home to buy another home. And, if I'm selling a home and buying another home, the supply isn't changing, right? So the inventory is essentially going to stay the same. And even people that are moving out of the state of California, they're buying another property in another state. So again, that inventory isn't changing. These people aren't selling their homes and just going to rent. But that's where we are at the moment. As more data comes up, I'll continue to update you. But my expectation is that we continue to look, we're going to have a lack of inventory through the end of the year, which is going to result in again, lower buyer demand. People are going to report lower buyer demand numbers, which is people are going to think that, well, there's less buyers out there. No, it's less inventory for buyers to purchase. And that's why buyer demand is going to be down. But again, as I get more information, I'll continue to put it out there. I appreciate you taking the time to watch. If you haven't done it already, give me a thumbs up and leave me a comment below if you have a question. Otherwise, we will see you again soon. Have a great day. Bye-bye.